This meeting, I just came back this past weekend, Monday and Tuesday, I was in Miami. I was at the Family Office Super Summit. Hundreds, and actually I think it was about 1,000 people there from all over the world. South America, Eastern Europe, Russia, China, everywhere. Family offices, investors, people coming together and mixing and mingling and getting to build relationships with one another so that in the future we can go out and do business. And it's pretty amazing the different modalities, the different alternative investments that are out there today.
What is it? What's the name?
This is the guy that puts it together. His name is Richard Wilson.
No, the name
And the conference is the Miami Super Summit, Family Office Super Summit. He does about 20 events a year, and this is his biggest event that he does. And it was in Miami. It was in the Intercontinental. It was amazing. Really, 2 days full of just, and he has speakers and they have panels and questions, and it was really it's done really well. And if you guys ever get a chance to go to one of these events, I highly recommend it. So, I created this group with the vision that to help people go out and achieve success and create your lifestyle by your design and not living by default, right? And one way that we can do it is by creating passive residual income through different, you gotta sing now. That's the rule.
I'll mute my phone right now.
Where's the mic?
I think it's going to be a cappella this time.
So my goal is to bring content every month for you guys, right? And that's one of the reasons why I've got the questionnaires out there, so we know what you guys want to hear. It's great that I stand up here every month and yap, but if it's not something that you guys want to hear or is pertinent for you, then I lost you, right? Then there's no point in being here. So tonight, what I spent a couple of weeks ago, we were in Boston at the sponsorship, and I went over on, when we put a property in a contract, right? We do our due diligence. Then we say, okay, we're going to go for it, right? Then our money goes non-refundable. Then what do we have to do? We have to go out and we have to find the money. We have to go out and we have to start talking to people. We have to put together our pitch, our presentation, right? And there are ways of doing it, and then there is ways of doing it, right? So I came out and I said, let me show you what a crappy presentation looks like, and let me show you what a presentation looks like that raised money and is still raising money, and then there's a format. It's like a template, right, of how and where to put the information. Anywhere you want. You want another chair?
I'm fine.
There's a chair over here on the end.
Oh, okay.
Yeah?
Thank you.
Here? Okay, great.
Thank you.
So I want to talk a little bit later about that. The building that you're living, that we're in right now, this is a testament to the two people sitting here on what you can do with a property that was contaminated, that was old, that was broken, that had environmental issues. Okay, Julie is is an interior designer, and Abraham is going to be talking to us. He is, he started environmental engineering back when they had 2 rocks to make fire with. Way back then. Way back then. No, really. He's waiting later. He's keeping score.
Yes, he is.
But Abraham, he's been in the environmental industry sustainability for the last, 30, 40 years, even more probably. He got involved in that before it was a thing, before anyone was talking about it. So he and Julie came out. I want to let him talk a little bit more about what they did, but this is a product of what you can do when you understand sustainability, when you understand environmental needs, interior design, how to make the space work as well. Because you can have a space like this, but it can be just horrible, walls and plating. So the combination of the two really went, and you can see how well it is. This is a live and work space. Okay, so this is a place where they live, they come down, and they work. I think they live in this part of the house, the building. This is the work area, And over there, I like to say that that's Abe's doghouse. Okay, when he gets into trouble, that's where he hangs out. That's where and that's why you have the door. She's got the key. Julie's got the key. So these two things really, now when you're buying apartment buildings, when you're buying hotels, marinas, office buildings, doesn't matter what, even single family homes, duplexes, there's always that, that part of it that you can take and make it sustainable, make it energy efficient. Because what are the two ways of making money in real estate? Either you jack up the rent or you lower the expenses, right? When you have, for example, a hotel, and one of his niches is hotels. He's built multifamilies, he's brokered millions and millions of dollars of hotels and multifamilies. He's constructing now 80 units, 90 units?
160.
I was completely off. 160 unit townhomes, right? Sustainable project, okay? It cuts down the cost of your construction, but when you're done with it, the utility bill, right? The utility bill drops down so that now your bottom line, your NOI goes up, and you just increase the value of your asset by putting in sustainable, energy efficient products, right? So what I'm going to do now is I'm going to bring Abe. Abe has a company called Emerald Skyline Corporation, and they partnered up with a bunch of other companies around the world. ChargePoint?
Yes, which is
ChargePoint. You know Tesla?
Charging stations.
Right? They partnered up with ChargePoint to create different charging stations all around the place. So Abe's going to talk to us about sustainability, how to do it, where to find it. There's also grants, money that the government will give you, okay? And he's going to talk about where to find that and how that all works, okay? So Abe, rock and roll, baby.
Thank you very much, guys. First of all, I wanted to know, or I want you to know that container there is waiting for Nissan when he gets kicked out as well.
That's my dog. That's my doghouse.
That's his doghouse. Anyway, welcome to the building. Like Nissan said, this was a containable, a brownfield, meaning it was contaminated. We cleaned it up, and now it is what it is. We're going to go on probably going to get a LEED certification. Probably would be a gold LEED certification. A little bit about myself. I study environmental design. I'm from Costa Rica, and graduated from environmental design in '77. Yeah, a long time ago. And
See, I told you before they had electricity.
yeah, she did. And basically nobody knew what it was. So went back, got my architecture degree. So I got both degrees. I started practicing architecture in California. Came here to Florida, became a developer, became a broker, and built mostly multifamily here in South Florida. The last one I did was finished in 2008, just around the crash. 328 units in Jacksonville, multifamily, 3 stories, garden style. Mostly what I have done is new construction, but with Nissan I'm involved in properties that are already existing. I'm going to be talking to you about how sustainability can affect the bottom line, and what is sustainability. So you guys probably know a lot about what you think sustainability is, and one of the best examples of the definition is a building that is designed and operated to reduce overall impact of the built environment on human health and the natural environment. Efficiency using energy, water, and other sources, protecting occupant health, and improve employee productivity, reducing waste, pollution, environmental degradation. And this comes from a source which is the USGBC, which gives the most standard for sustainability, which is LEED, LEED certification, which is what we're going to basically obtain here. What is sustainability? Basically being energy efficient, resilience, be environmentally friendly, and promote the health. That's basically all that what it says. A little bit about Emerald Skyline. Emerald Skyline is a consulting firm that advises people like you when you buy a building what to do and how to make it sustainable. Couple of things that you have to know about sustainability: improve your property income, value, marketability, reduce utility bills and operational costs, which is what Nissan is talking about, enhance the health and well-being and productivity of these occupants, your tenants, fulfill environmental and social responsibility, and present a positive image and improve the community of life. All that is so important. It gives you an edge. If you have a sustainable building, all these things is going to give you an edge against the other building. Another rental building next to you, if you're sustainable, green, even if you don't have the certification, that will give you an edge. If you have the certification, it'll give you a better edge in the financial aspects of the building. Just to give you an idea of what you can achieve with a sustainable retrofit, is 19% less to obtain, costs 19% less to maintain, uses 25% less energy and water. This, a lot of people don't care, but it's important for the environment. Emits 36% fewer carbon dioxide emissions, and have a 27% higher rate of occupant satisfaction. If I have to go and live in a building, you have to choose between a healthy building and not such a healthy building, and a building that my energy is going to cost me 30-40% less, where do you think I'm going to go? So, that's something to think about. This is what I was referring to. If you buy a building, and this building, you retrofit it being sustainable, your lender, Fannie Mae, for example, is going to give you a lower rate. Why? Because it's likely you're not going to default on the loan. That's the reason, the main reason why you're going to get a lower rate. If you go and do a green certification such as LEED, you're going to get 10 basis points less for having this certification. And if you are seeking a certain amount of financing, you definitely are going to get about 5% more in financing money. That's very, very important. In addition to that, you're going to apply for tax credits, rebates for green buildings, and this Desire website, if you go there and you place your zip code where your building is, it'll give you all the rebates available there. It's very, very simple to use. Just go to this website and see what rebates you can get. Whoever wants me to send this deck, because some information there that you probably want to have, including this website, just
email it to Julie.
just
email it to everybody.
yeah, and then you will all have it there. Now, an exit the strategy. You always have an exit strategy in multifamily. Your investor want it. They don't want to be your partners forever. 5, 3 years, whatever it is. If you have a sustainable building, it's usually not. It's basically, your cap rate is going to be about 5 points less, 5% less. No, I mean, half of a percent. So that's important when you try to exit.
Talking about that, we bought a property in Atlanta, in Jackson County, and through Fannie, and they gave us requirements to put in low flow shower heads, toilets, and faucets. And when we do that, we're getting about 0.5% off of our interest rate.
Yes.
Just by doing that. And so we did that already, and now we filed for that decrease in our interest rate, and that is just an extra bump up in our NOI, which is bottom line, good for our investors, good for the environment, so it's a
And
great
if
program.
you're selling a building at a 7 cap,
Mhm.
and now you know that you can get a 6.5 cap,
That's right.
that's a
Huge.
big amount.
Yep.
It's huge.
So I have a question, when
Sure.
you're doing that, when does the bank actually do that? Do you have to do it first and then go to the bank and say, hey, I've done this, and then you refinance?
No, while you're,
Or do you do that?
while you're in your due diligence and the
Okay.
lender is underwriting you,
Okay,
right? You can tell them, hey, if you're getting a Fannie loan, then you can tell them, I wanna do the Fannie Green program. The lender will go and they will do their inspection on the property, okay? A lender inspection, and then they will come out and give you a list of everything that you need to do. And then, if you agree to that, they will then take that money and put it into a CapEx account when you close. So you have to raise that capital, they put it in CapEx, and then you do the work, and that money comes out, you do the work, they give you back that capital, and then you can fill out the forms, send it back to Fannie, and then they reduce the interest rate.
does it matter the age of the building that you're working with? I mean, if I find something that's built in the sixties, can I go back and retrofit where I
Well,
can?
first of all, you know, you buy something in the 60s, you gotta watch for certain things that you don't have. there.
Asbestos,
Asbestos and
uh,
everything else that
wiring,
goes with it.
yeah, wiring,
Plumbing, you know,
Plumbing.
you look at all these areas.
lead,
But no, you can do this on buildings that are 200 years old.
wow.
I mean, really, it doesn't, because you probably are in the inner cities, and they want you to renovate those buildings. The buildings, the way you see them right now, I would say 50% of those buildings are going to be renovated in a short period of time, within the next 20 years, because the technology is so fast, and we have discovered so many things about what those buildings don't work anymore.
Mhm.
If you don't renovate your buildings,
Mhm.
you're going to be out of business.
How big does the project need to be in order to really look at doing something like this? I know for the water, it doesn't have to be a big project, because we can do low flow shower heads, we can replace the toilets in there,
Mhm.
but
Well, I don't deal with the individual homes, but I can tell you, you can do it in individual homes as well. Multifamily,
but where it makes sense financially, I'm trying to figure what a break-even point would be.
you know, when I hear what Ms. Ann was saying, sometimes when you buy a 10-unit building, you make more money than a 100-unit building. So you never know. It has to make sense. So just to give you an idea, if I buy a 10-unit building, just small, and I know my tenants are going to pay more if I do certain things, because they're going to get that money back. Like, you know, if you buy a 10-unit duplex, just to give you an example, and you have 1,200 square feet, and you have no building, just in electricity, you're going to be spending closer to $200 a month. Do you agree with me on that?
Mhm.
Pretty much. You start doing insulation, okay? Change it to LEDs, you know, water, maybe even harvest some water that you use for your landscape. You get a loan to put some solar panels in a carport, which increases your real estate right now, and you put the solar carport, which give you light for your parking and things like that. You can sell that to your tenants, and they will pay you more, because it's money that is coming out of the pocket every month,
Mhm.
that instead of paying it to the utility or anything else, or the water, they can afford to pay it to you. So it depends on how much you do and how much you can reduce your cost. It doesn't matter if it's a 10-unit building or a 100-unit building. The best thing you can do is for new construction. For new construction, definitely it's not going to cost you that much. The people that do new construction and don't do sustainable buildings, they're crazy. And not only sustainable, smart buildings. You really have to have smart buildings, because the best thing to do is to turn the switch off. And how do you do that? Either manually, or you have buildings that are smart buildings that you can do so much with a smart building, not only in water, but in security, in energy, in all these kind of things. So all these are changes that we haven't. And moving forward, we're going to even having more changes. Insulation is critical. You have to check your windows, because you lose a lot of energy through the windows. If you are doing an inspection on your buildings and you see that, especially on older buildings, you gotta do some changes there, which are minimum, that will reduce your energy cost, or the energy cost of your tenants. So by doing that, they want to be in your building. Air conditions. The quality of the air is very important. Over here, this was a contaminated building, but I can tell you the quality of the air here is amazing. We were renting before, and you will see dark spots and dust everywhere with the air conditioning. Here you don't feel that, and you don't hear the spikes of these units, because it's variable frequency drives, all of them. We have 5 of them, so we can choose and pick which one we can use. Right now, we have those 2, because everybody here generates about 50 BTUs per hour, so I gotta accommodate for everybody. So some people there, some people won't, but depends on your weight. Okay, so I only have 20 minutes.
That's right, I got 10 minutes left.
Thank you for answering the questions.
Yeah, but again, it's just like anything else, you gotta do the numbers, right? If Fannie is gonna tell you, listen, we want $500,000 worth of work to be done,
Okay.
but it doesn't make sense, then it doesn't make sense, right? But it also works on the flip side. We have a property where we didn't get a Fannie green loan, but we decided to implement the green strategy that we did on another property, low flow and whatnot, because we're the ones paying for utilities. So on this property, we're paying for utilities, so let's drop our utility bill down. This property, the tenant is paying, let's drop their utility bill down. It gives them an incentive to stay, and like Abe said, it's a selling point for other people. You can go live over there, but you can come live by us and get the same thing, but you're paying less over here in utility bills. So it's a win-win any way you kind of slice it.
Okay, thanks for clarifying that. If you look at a building, this is how to look at the sustainable strategies. You got to do a review of the building, okay, which you can hire us to do, or you can do it. But there are companies like ours in every place that will give you that. Hopefully, will remember me anyway. But there are a lot of companies that are very good as well. Then, after you see what the problems are, you identify these strategies that you need to implement. That goes into the implementation. Then, you want to definitely get some certification. For financial matters, is a must. If you don't get this certification, you're not going to tell the lenders and your investors that this building is going to have an edge against competition. So you want to do that and get all the benefits that green certification can give you. Exit strategy, negotiating with the banks, lower rates, more money, all that kind of thing.
Can the certifications be marketed? I mean, can you put it on a website when you're actually marketing to renters?
Oh yeah.
Okay.
The LEED certification is recognized worldwide, not only in the United States.
The what certificate?
LEED, Leader in Environmental and Energy Design. The LEED. Let me go back.
There are companies that I think will only rent when there is a lead building.
Right
I
here.
know Wells Fargo.
Right, a lot of government offices, a lot of government development departments won't rent in a building that is not LEED, because they consider it to be a sick building.
Yeah, a lot of Class A office buildings need,
Yeah.
it's a competitive
Yeah.
edge, and it's very important to millennials.
This is an initiative, is the Energy Efficiency Initiative by the U.S. government, and there's many things on that initiative. One of the initiatives is, if you are a government agency and need to move from that particular building to another one, that building need to be having some sort of certification, either LEED or something else. If not, you will not be able to rent to the government. Those are just classical examples on things that you can do on energy, on water, recycle. Over here, in this building, we don't have garbage. We recycle everything. And the biologicals, we have a composting in the back, which I'm in charge. And plastic and paper go here. And then once a week, I take it for free to their rate. They take it for free. I don't have to pay anything. That's important. That's a cost that I'm lowering. I don't have that cost. And it's good for the environment. Weatherize it. You've got to remember, and insulate, that's very important. This, you can look at it. I've been talking about benefits. It's just to give you an idea of what is good for the developer if he's in a new building, good for the tenant, and good for the owner when he purchases a building and then disposes of it. It gives you the benefits of going green in a nutshell. I thought that that was a very nice slide and everybody can have it. How can you finance these projects to be sustainable, which is important? Well, equipment leasing, you can lease equipment from leasing companies. You can get in a major retrofit, you can get a loan and put it in the first position if you already have one. If it's more than 50%, you want to do that. You can get rebates and credits. Sometimes I was looking at some rebates for a friend of mine that had a hotel, and when it came to it, he was getting about 250 toilets already installed for like $20. So you got to look for those things. Sometimes rebates depend on the company. They want to introduce something that is sustainable. You got to look for that. ESCO. What is ESCO? ESCO is basically the sharing of energy. You can look at companies that will give you, let's say, the LEDs and don't charge you anything. And then there is a cost sharing. But to do that is tricky because they want you to show them the bills and how they are going to figure it out. If you add more appliances or not, well, there are systems that you can implement, smart systems. That's why a smart building comes into play. We have a company that we partner with. It's called Blue Pillar. That basically they control where the source of the energy comes out, who uses the energy, and how much in a real time, and every single switch that is directed to that energy coming in, it uses the energy, and that's important for the building. So the other course, obviously you can do this is working capital. You can use your cash flow to retrofit your building, which a lot of people do. And the sixth one is the PACE program. We partners with PACE. And the PACE program is a program, you as a banker probably know about PACE, that it works at the level of the taxation. So you borrow the money only on the sustainable retrofits that you're going to do, or sustainable initiatives in a new building that has to do with energy efficiency, with water reduction, with sustainable implementation of all sorts, with resilience. All that you can finance with PACE at the tax level. It's almost like a bond. It has many benefits, and I'm going to go in detail with that because I have a little deck just on PACE because we partners with the Counterpoint, which owns PACE, the PACE program. What is PACE? Is a commercial property assessed clean energy. It's a public and private partnership. It finances 100% of all your energy efficiency, renewable, water conservation, resiliency, improvements related to cost, retrofits, and all this on the construction items. It is collected, this is what I was trying to tell you, is at the tax level. The good thing about it is that you can get 25 to 30-something% of the value of the building on PACE. PACE will give you that money at about 5 to 6%. But the nice thing about it is it will give it to you for 25, 30 years at the tax level, which means it's off the balance sheet. You're not going to see it in your balance sheet. It's almost also like a ground lease. So you can pay it whenever you want to, or you can transfer the building. You can sell the building with the ground lease, right? You can buy a building with the ground lease, and it's off the balance sheet. So that's very important. We are in 35 states, and that money is there to grab folks. And that money is how I do the project with PACE, new construction or retrofit of existing buildings. What buildings? Hospitality, dear to my life, multifamily, multi-tenants, new construction. This is a very clear example of how a PACE program works versus conventional. To the left, you see the conventional. You come up with an equity stack of, let's say, 20%. Then you have the mezzanine loan. Usually, that's a very expensive loan. You got to pay about 10 to 15% for that if you go with a mezzanine loan in your capital stack, right? That's how much you pay?
Yeah.
Well, and then you have your equity, which is about 60 to 70%. You've got to come up with your equity. But the capital stack on the left side is very different than in the right side. Why? Because PACE replaces the capital stack. You can get a capital stack there with PACE money. 25, 30 years to pay at the level of the taxation when you pay your taxes, and off the balance sheet. And instead of paying 10 to 15%, you are paying 5 to 7%, probably no points. That's important. And I would definitely suggest, if you can get a PACE loan, get it. Because it's, I don't want to say free money, but compared to this, it's pretty good.
Do you need someone specific to help you?
We do that.
So you need someone on your team that
Yes.
is connected to PACE, that knows how to underwrite, knows how to
Yes.
speak to
And
them.
we're partners with Counterpoint, which is PACE. They own PACE. And Hannon Armstrong is the REIT that is behind them, which is a $3 billion REIT. They don't sell the paper. They keep all the paper. They don't sell it. The REIT has its own money. They also are involved in very other 5 minutes. They also are involved in other businesses, like solar farms, just to give you an idea. We are doing a solar farm in Arizona. They like that type of deal. So when we need the financing, that's one of the companies I'm going to approach. I know I gotta go. 100% finances, okay, I already covered all that. Similar to the ground lease, yes, I already covered that. New constructions, major renovations, off the balance sheet, non-recourse. This is non-recourse. Looks at the building. That's very important. Everybody wants you to sign. We're not going to do that. That's really, really good. Transferable at sales, meaning that you sell it, you can prepay it, and there are different ways that you can do it, or sell it to the new buyer and keep that as a ground lease, almost, or a PACE program at the tax level. What are the improvements, renewable energy improvements, which is charging stations, different types of energy such as solar. You can retrofit anything that has to do with air conditions, windows, roofing, lighting. Green roof is very interesting, you can do that. Water conservation, flood mitigation, shutters, whatever you want to do. Impact windows, that's allowed. Okay, roof, I got that. All right. The window envelope is very important. You need to make sure that your window envelope is insulated, and this is one of the main things you have to look into when you buy a property, because that's a lot of money thrown out the window, literally. Green roofs, I like that picture there. We're in 34 states, and this is my contact information in case you want it. I did it.
Thank you.
Thank you very much.
Go back a couple
Awesome.
slides.
Anybody have any questions?
Can we get this power
Get
lines, or?
Yeah, we'll send it to Julie and she'll
Oh, okay.
send it to
Just make sure
everybody.
you guys put your email addresses on the
Okay.
Registration.
Sure,
form, so
go
I
ahead.
can add it
So
to my
when
email
you get
list.
that list from the bank when you're applying for the money, do you get to pick what you want to
What do you
actually
mean by
use?
list?
Well, it sounded like you actually, like if you apply for the green loan, you actually get a list back and they say these are the things that you need to do in order to
Yeah.
qualify for the loan.
Yeah.
Are you able to pick from that list or do you have to do everything
Well,
on the
there are
list?
two ways to do it.
Okay.
You can go and hire somebody like us, and we create a list, and with that list you go to the bank and tell them what you want to do. All right? And you can do that with new construction as well. New construction is much easier. Oh, one thing I forgot. If the retrofit is less than $1 million, I can give you the money in 48 hours. If it's more, then I have to go through the process. But if it's less than $1 million, I can underwrite it in 48 hours.
How many times can you get a loan like that on one property? One time?
One time, yeah, one time. So we better make it work.
Mm-hmm.
But if you want to get it the second time, prepay that
Right, and then,
and get another one. And they make it very simple to do prepayments.
Is it treated?
I think the answer is you don't have to do all of those things, it just depends on the project and what the needs
Yeah.
of the
But you know,
project are.
if you don't have somebody like us saying those are the things you want to do, they will send somebody like us and tell you, okay, if you do this, you're gonna get 10 basic points less. If you do this and get a certification, you're gonna get more money. You're gonna get 5% less, you know, that kind of thing.
mm-hmm.
Is it treated like a mortgage or is it a tax lien? So they have priority over the bank? Because you said it's built
First of
with
all,
tax, right?
you know, we cannot foreclose. So it's not a lien.
Mm.
It's like at the same level as the mortgage. You allow us to put that at the same level as the mortgage. When you pay the mortgage, I mean your taxes, sorry,
Yeah,
you're paying the property.
same payment.
Yes, because the city has to accept it and the owner has to accept it. So there is no lien. The only lien is when you don't pay your taxes. Then what happens? Somebody buys those tax liens and they can foreclose on you.
Right.
That's how it works.
Awesome.
But we can foreclose.
Mhm.
Do you have like prepayment penalties, or you can play it at any time you want?
You can, depends on how you negotiate it. Most likely, they're very flexible. There are sometimes that there is no prepayment penalty. And if there is, it's very little. They're not there to make a lot of money. It's a green REIT, and they keep their own paper.
Right, and you can transfer it to the next buyer. So
Yes.
it's not like a loan where if you can't assume the loan, then there's a prepayment penalty. This is assumable 100 times, over and over and over and over again, to as many buyers as the property will transfer to.
I've done it on 2 houses in Korea.
This
Yes.
is called white green there.
Why?
Yes. But they really not doing too much commercial. but they are very good at doing
And the
residential.
roof and the impact windows.
Yes, you can do that.
Awesome, man. All right, well, thanks a lot, Ed.
Yep.
Great, thank you very much.
You're
Awesome. So, all right, is that good?
Yeah.
Yeah.
Very good. So we understand now, when we're looking at a property, there's another aspect to look at. It's not just the deferred maintenance. It's not just, the property management company. This is another line item that we can look at, that we can say, okay, how can we make this property more sustainable to reduce our expenses and raise the NOI? It's kind of another stream of income for that property, right? We're looking at different ways of lowering our expenses, creating more value for our residents, and ultimately, in the end, for the next buyer that's coming along, right? We want to make that property really pop, and the next buyer, and they'll say, you know what, maybe we'll pay a little bit more because, you know what, it looks better, it's a better asset, it's got the sustainability aspect to it. So that's great, awesome. So I was talking about, before we started, about the Family Office Conference and whatnot. So Richard Wilson wrote a book. It's one of the first books about the single family office. Family office, when you make enough money, when you have a lot of money, you can create a family office where you hire your advisors, your real estate people, your stocks and bonds and whatnot, your advisors, you hire them for your family to work for your family, to go out and put investments out, to move that empire along and continue to build wealth for that family. So he went out and he created the family office, the single family office conferences and whatnot, and he put together this book. And this book talks about how to create a family office, how to invest as a family office, what to look for as a family office if you were going to create a family office. Now, why do I think that's important? Because when we go out and we start building relationships, when we go to these networking events, when we go to these conferences, and we're talking, right? It's right now when we're starting out, we're hitting our friends and family, right? We're raising capital through the network that we know, right? The people that we know. Eventually, when we go and we get a little bit bigger, right? And hopefully you do that fast, right? You can go, you start moving along. It's a lot easier to have a few people, rather than a whole bunch that can write out big checks, right? A couple of ways they do that is, one, they need to get to know you. They need to see your track record. They want to make sure that you are an expert in the market that you're buying in, okay? And this is kind of why what our strategy is now, is buying the smaller assets in a market so that suddenly we can have 3, 4, 5, 6 assets. Now we can say we're the experts in that market. And those are easier to close, stronger value plays and whatnot. So he put together the book. And again, why is it important? Because when you're going out there and you want somebody to stroke you a check for $2, $3, $4, $5, $10 million for the equity stake, you need to know how to speak to them, right? You need to know how to underwrite for their level, for their understanding. Because the way we underwrite now and the way our property packages are put together is to go out and to talk to our friends and family, to go to our network, our sophisticated and accredited investors, and say, here, this is what we're doing, why don't you jump on board? But when you go into those bigger family offices, when you're going to the funds, the ultra-high net worth investors, the big family offices, or even the smaller family offices, they do things a little differently. They underwrite a little differently. They look at some things from a different perspective. They're looking for investments for a certain reason. And I think it's very, very helpful to learn how they think, so that when we're talking to them, or when we're also looking for assets, okay, we're thinking in that mindset as well, so that we can go out and suddenly approach them and say, hey, this is what you're looking for, this is how you want to be presented here, right? It automatically puts you ahead of everybody else that's pitching these people. Because I was in that conference, and there might have been 700, 800 people walking around. There may have been about 100 family offices and 600, 700 syndicators like us. So everybody's out there looking for money. Everybody's got a deal. I got the deal of a century. I got 900 units. units, I've got 400 units, I've got 50 units, I'm in the best market, you're in the worst market, blah, 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 blah. But what's going to set you apart from everybody else is not necessarily the opportunity that you're presenting it, but how you're presenting it to the family office. Does that make sense?
Mm-hmm.
Right? Who would like a book? Okay, great. Pick a card. Don't look, just pick a card. We're going to raffle it off. We're going to see who gets one. What's that name? Oh, I think it's rigged. How much did you pay him? How much did you pay him? How much did you pay him? Cliff walked in and he saw the book. I was talking to him about it. He's like, look, if I don't win the book, I'll buy it. I'll buy it. There you go. There you go. There's one. Good for you, man. Congratulations.
That's awesome.
All right. Very good. Very good. All right. So we came here also, to talk about how to put presentations together, right? It's not just important to go out and to find an asset, underwrite it, and do what you got to do. Presenting, right, is so important. Right? We always say, oh, thank you, so much. Appreciate it. Thank you. There's a way of selling, and then there is a way of not selling by giving everything and showing it and presenting, right? A lot of times when you have to go and you have to sell, you have to do a hard sell, your tools are not working for you, okay? I want to show you a tool that my partner Laura, she actually put it together, but between the two of us and what we learned in the past about how to put things together, we came up with a property package that we use always, and it's helped us raise millions and millions of dollars. It's a template, I can email this to you as well so that you guys can look at it. You can pop it out, move it, do what you want with it. So, when we're presenting, the first thing we want to do is we want to put the sizzle, right? You want the sizzle sells, right? What could be sizzle on a property? What would be something that you would think would be sizzling?
Like pictures.
Pictures.
Landscape.
Landscaping. What information is sizzle information?
Newly renovated.
Newly renovated. How about how much money the investors are going to make?
Mm-hmm.
Do you want your investor to wait 45 pages until they learn how much they're going to make? Absolutely not, right? You want them to open it up, go, wow, that's a cool little picture. Love their logo. 1, 2, okay, well, oh wow, I'm going to make that much, right? You want to catch them immediately. Now, there's a great software out there that we use, okay? It's called DocSend, D-O-C-S-E-N-D, DocSend, okay? Well, you might want to write that down because when you're presenting your property package to anyone, let's say I mail it to Dale, right? How many of us do this, right? We mail something out and then we stare at the screen. All right, when are they going to respond? I got 2 weeks to close. Come on. Come on. You don't want to send another email because then you look desperate, right? Or if you call and like, yeah. So how do you know if they've read it? How do you know if they've opened it? How do you know what part of that property package they like the most? Because there's several different types of people out there, right? There are people that say, I don't care about the pictures, I don't care about the landscaping, I don't care what year it is. Show me the numbers.
Yeah.
I want the numbers. I don't give a shit about nothing else. Show me the numbers. And then other people, well, what kind of, the 2 bedrooms, how are they designed? Does it flow? Are they small? Are they big? Is it wood? Is it concrete? Is it prefab? Is it, right? So you want to know what these people are looking at so you can also direct your attention for that individual person, right? So DocSend, what it does, you upload your document to DocSend, then you send a link, and when your investor opens it up, you get an email. Ding! Hey, John Dale just opened up your property package, and he spent 3 minutes on page 5. Totally blew by everything else. Spent another 6 minutes on page 12. Ooh, okay. So Dale likes numbers, okay, because page 5 was the numbers. On page 12, it was the sensitivity analysis. So he's a numbers kind of guy. He's looking at that. So now I know Dale opened it, he spent time on this page, and this page, right? So when next time, now, 1 or 2 days go by, pick up the phone. Hey Dale, how are you? Great, good. Pretty amazing property, isn't it? Yeah. How are those numbers? Don't those numbers look awesome? Yes, they do. They're fantastic. What did you think? What did you like specifically about those numbers? Oh, well, I like the fact that blah, 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 blah. So now you see how using DocSend, just that one tool, you can now direct your contact to that individual investor the way they need to be contacted. Also, what it does for you, let's say you go and people are blown by the first 10 pages and they're on page 11 for half a second, half a minute, and page 12, and they're not really staying on any pages. If you start looking and take like a survey of all the people that you send it out to, and you see that you're getting the same kind of read, you can either say, wow, my property package is awesome because everybody's looking. Everybody's going to where I want them to. I want them to go to the numbers. I want them to go to the pictures. But if they're not going to the numbers, if they're not going to that, if they're not spending any time on your property package, that should be a little buzz in your head saying, maybe we need to adjust things. So you see how that can also help you build the best property package so that you can hook, line, and sinker as soon as they open that email, right? So on the left side, we have a property package. This is one of the properties that we did in Jackson County in Commerce, Georgia, Jackson Place Apartments. It's a 50-unit property. This was one of the properties that, while we had it under contract, the on-site property manager raised the rents to our pro forma levels, and we didn't even close on it. That's how strong the market was. So we said we were going to put about $3,000 into renovations into the property, and when we're done with that, we'll take the rents from $680 to $750. Well, he was doing that already without spending $3,000 into that property. So now we're putting money into it, and this is the property, Jackson Place. This is the property that we have the green loan on, the Fannie Green. So we just finished doing the water reduction on that. We filed it with Fannie, and we're waiting for them to reduce our interest rate. And not only that, but we also, this is one property and this is another property, but the property packages are the same. But these two properties were managed by the same property management company, and these guys were really big companies. They, what did I just drop? Glasses. Oh, glasses. I can't see. Here. Yeah. So the property management company was charging us per property $500 for their property management software. For 50 units, $500. That's a lot of money. Mm-hmm. Okay? So we found another property management company that's just as good, smaller. They love 50 units and whatnot. So that $500 went to under $100 per property. Just for that. That's a savings. That bumps up the NOI. The reduction in property management cost, okay, on each property, on the conservative side, is $1,000. $1,000 times 12 months is $12,000. How much did we just increase the value of each property? Huh? $120,000 just by doing that little thing. Now on a property that's a 50 unit, $120,000 bump is pretty strong. And on top of that, we're getting them to do our other property in Athens. So they said once they do that property, they'll be able to lower everyone down even a little bit more. And on the Athens property, come January 1, 44 units are going up $100. Now, $100, 44 units, that's $4,400 a month. Bump, right? Times 12, what is that, $48,000, $50,000, something about that, right? How much did we just raise the property value? $500,000, just by doing that. So $500,000 with that, another $100,000 from the property manager. So we just, without even doing anything, got a $600,000 increase in value just from doing that one little thing. So being in an emerging market is really, really awesome. But being able to present to your investors a property in an awesome market is even better. So Jackson Place, this was not done by us. We have another person that we just brought on. He works out of the Atlanta market, Ben, and he put this together. He sent this to me. I immediately sent this to my partner Laura, and I said, we cannot distribute this. So this is a property package that you don't want to look like, okay? Obviously, you can see how here, it doesn't pop, right? Forget the word draft, right? So you take that out, but you see, look at this
Yeah.
and look at this, right? This pops, it's colors. Not only that, but you see how it's landscape? People like to see things in a landscape mode. This is why also when we take our phones, right? Instead of doing it this way, we do it this way, the landscape. It's visually more pleasing and easier for the eyes. But check out Jackson Place. So we're going here. Oh, we'll do this. All right, look at that. All right, look at that. I'm just going to go through. So the first couple of pages really are very, very bland. Doesn't excite you, right? Does that excite anybody?
No.
Right? If you were to receive that in your inbox, you'd be like, you know what, delete. If you can't even take 5 minutes to make something look good, how could you work on a multifamily property and do renovation and make the inside look nice and make the outside? You can't even put a presentation together. You can't do it. No. Right? That's like somebody's house in Cleveland somewhere. You have no idea what that is. That's not. Look at that. What is that? The grass is dead. The bushes are up. I mean, that's the picture you choose, right?
An old car in the front.
Exactly, right? The leaves on the ground. It doesn't. It's not appealing. You want people when they look at it to start savoring, to start, wow, right? You want that effect. And you got to have your confidentiality and disclaimers and blah, 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 okay? Pay attention to this table of contents, okay? Look at it, okay? Very small, very, very bleak.
It actually cut off on the bottom.
Yeah, cut off, as it wasn't even the table wasn't.
The table, what happened, right?
And nothing.
Not enough digital ink for the computer to continue, right? Right?
And there's too much blank space.
Too much blank space, a lot of loss. It's just, look.
Created in Word.
What color is this?
Yeah.
Gray. It's gray. It's I love gray. We do gray interiors, but when you want something to pop, when you want to catch somebody's attention, executive summary. Look at this. A little. What is it, 10 sentences here? Okay? Rental rate upside. So all this, the projected returns. Now, sometimes you have different types of people. You have visual, and then you have people that like to read, right? Mm-hmm. I like to see charts. I like to see graphs. I like to see, tables and what. If I have to start reading all this the way it is, by the third word, oh my God, this is not for me, right? So now obviously you're going to have text and whatnot, but it's got to be put in a certain way and in a certain place. Investment terms and timing. Does that sound attractive? Does that sound, appealing? Terms and timing. The South Atlantic Economic Snapshot. Does that look any...
That's like a
Some
map
map
that
is
you would
a map
get
of
on
the-
Google or something.
Right, but I mean, this is the part where you're talking about the market, the excitement, what's happening. Holy shit, look what's going on here. Wow, it's number 1, it's number 5, right? It's highlighted in green. Highlighted in green.
Sustainable.
It's sustainable, absolutely, it's green. So basically, so you can see here, right, how it's very basic. Very, very basic, right? There's not much to go on here, not much meat, nothing to entice the senses, okay? Now,
You can use the...
imagine you get this and you open it up, okay? Now, first thing, when we think of a success graph, which way does the line go?
Up.
From the bottom left to the bottom right. Where are we going? From the bottom left to the bottom right. Where's the arrow going? Where is it taking you? Psychologically, back in the brain, we're hitting the, hey, this is a success, right? You join us, you become a success. But look at the colors. Now, if you look at my business cards, right, it's purple and gold, okay? Why purple and gold?
Royalty.
Royalty, right? The kings and the queens wear the purple and the gold. It's all about what we're hitting inside the brain of people, right? Subconsciously, what we're making them think. So you got the purple, you got the gold, you've got the circle, the whole thing, right? It's all part of that setup. So you have here the name of the property, the market, all that stuff, right? Now we go into it. Now, doesn't that look a little bit nicer than the other content? You know, the colors are pleasing, everything is nice. And we have, you know, you want to put the information of everybody, of all the general partners that are working on that, right? You want to create the team. You want to let everybody know who's on the team, because you don't want to be that lone ranger. You want to let everybody know you've got the underwriter, the analyzer, the this, the da-da-da-da. All right. Remember the table of contents that we didn't have enough ink on the bottom? Isn't this a more in-depth, right? You have more. It suddenly, it tells the person looking at it, okay, two things. Get ready, because there's a lot of information, and two, there's a lot of information, right? So we're going to give you a lot of info, so get ready for it. Now, you always want to have your logo up there, somewhere, right? You want people to know where you're coming from. And again, we have the arrow pointing to the right, all these little psychological things that are happening. And thank you very much. Now, isn't that a nicer picture of the one that we saw, right? The front part. But look how many pictures we're throwing in here, right? You got another picture over there. Properties, beautiful properties, right? You got the nice roofs. You got another picture of the sign. Okay? See the arrow going to the right?
It's working.
Okay. Thank you. The investment opportunity. Okay? Boom. Page 4, we're already talking about how much equity we need, how big the property is, what year it was constructed, what we're selling it for, and the whole thing. So we're telling people, this is what's happening right now. This is the price, this is it, this is what's going on. $1,000 a shares, minimum 50 shares, this is what we're doing, okay? And then boom! Then it's there in all its glory. The investment opportunity, okay? I want to go back to this one. Where is it? Do we even have it in that? Oh, okay. Let's. You gotta check this out. Where is it? I just close it up. There we go. All right. Look at this one, and look at that one. Investment terms and timing. The investment opportunity. Look at the way it lays out. Look at the flow, right? The sponsor is offering LP equity partners a minimum of 25, blah, 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 blah. Right here. Forget what the sponsor is offering, right? Class A members projected to receive 53.3, 10%, 117. Here's how it is. Right there. This now will tell people, I want more. How are they going to do this? This is what's attractive. In any package, in any presentation, you want to sell the sizzle first. You want to get people excited. So you got to know what excites them. Pictures, graphs, text, numbers, landscape. What excites this person that you're talking to? And pitch it to them. So numbers, right? Whenever an investor's looking, they're usually looking at the numbers, right? Show me the numbers. How much money? I'm giving you 50, giving you 100, half, whatever it is. What am I getting back, right? Now, when you have something like this, right, and you put a lot of effort into it, okay, it translates into other things. You know, how you do one thing is how you do everything, right? So if this is how we're doing that, then that's how we're doing everything. If this is how we're doing this, This is how we're doing everything. We're taking time and care to making it exceptional, right? So here you've got, and you see the graph on the left, the equity investment summary. You see how small it is? You know, it just talks about year 1 NOI, year 2 NOI, stabilized, projected cap rate, exit cap rate, and so forth, the whole period. And then here, it actually goes further. It actually breaks down on the bottom on that box here, right? You see it says investors' preferred return. So immediately you know what you're getting. You're getting preferred return. It's an 8% return. You immediately know that you're getting 70%, so the split here is 70-30, right? Projected average cash-on-cash distributions, 117.6%, so you know immediately, because it says here, 5 years. So you know, all you gotta do is take that, divide it by 5, and that's what you're gonna get, and it's right here on the bottom line, on the next line. Average cash-on-cash to investors over 5 years, 23.5. Your IRR, if anybody likes IRR, I personally don't like IRR. Not many people understand it. There's, I think, 2 or 3 different ways of calculating IRR. And when somebody says, what's the IRR? They probably don't know what they're talking about themselves. They just think they know. So I like to keep it out. But because we're talking to the family offices, okay, that's what they want to look at, right? These bigger guys, this is what they want to know, what their IRR. We have an investor who, he invests, you know, he came in 2 of our properties, invested $500,000 into each one. He wanted part of the GP and part of the LP because he wants to create a 30% IRR for himself on every deal that he does. So he needs a little bit from this and a little bit from that, right? So these bigger people, they want IRR. When you're talking to friends and family and you're raising money from friends and family, do not talk IRR. Just leave it out. If they say IRR, what's the IRR? Ask them, well, how do you calculate IRR? What do you think IRR is? And IRR stands for internal rate of return, okay? It's very confusing. And then your equity multiple, right? 2x. Again, these last 2 lines are more for the family offices, the big funds, those guys, because that's what they like to listen. That's what they like to talk about. What's my equity multiple? Meaning if I put $100,000, how much am I going to get on that? 1x, 2x, 3x, what's my multiple on my equity? But they want to see that. I wouldn't necessarily put this into raising capital from sophisticated investors that are in your market. It's a little, again, you want to make it simple for people, right? Make it very simple for someone to understand. Return on investment, ROI, super simple, right? I put my money in, this is how much I get on my money. I get 8%, 10%, 20%. That's my return on investment. It's easy. Internal rate of return talks about the rate that the company is making versus some other. Convoluted, it's complicated. But you can see how this differs a little bit from your regular property package, or what I like to call them investment summaries, okay? Property package sounds that's a property package. This is an investment summary, okay? Remember, how you present it, how you talk, the words, everything. All right. Investment opportunity. Now we talk about what we're doing, right? It talks about here, we're able to secure a purchase contract at that price per unit, how much we're going to put in per total, per unit, what it's going to look like, everything. And then we have here highlights. You always want to highlight things that are super important that you want people to look at, right? In Atlanta's Northeast Corridor, which is projected to outpace the rest of Atlanta metro in population growth, blah, 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 natural income projected to increase more than 13% by 2020. Is that sizzle? Is that something that's going to blow somebody out of the water? When I see that, that's amazing. As an investor, you want to see that. And we were talking about Jackson County, right? So when you see something like this in a county or in a market that you're going at, it's amazing. You want to be in that market because it's growing. And that's where that appreciation comes in. Again, see the arrows? Going this way. Going success. What does that look like?
A house.
A house. What else does it look like?
An arrow up.
An arrow going up. Are we going up? We're going up. We're going up. We're picture, another picture. So you see how in one slide you can incorporate so much information consciously and subconsciously and look at that. Which one would you rather look at?
Well,
Which one do you think would make you want to invest? Exactly. Investment opportunity. So again, here we talk more. Do you remember here how many graphs and what we did? There was this little one, sources and uses, right? Property information. What else did we have here? And that was about it. Sorry, yes, table of contents, right? That chart. This, the investment terms and timing. And the comparables, the unit mix, which is not really, and your historical financials. Look at this. Look at this. I'm going to leave that up, okay, over here because we're going to go. Now on this side, right, let's look how many graphs and what we've put on so far. So here we have this, numbers, right? A lot of numbers, a lot of information, a lot is going on here. You've got your going in cap rate, your stabilized cap rate at year 5. I mean, Jesus, look, going in cap rate. Where is it? Here, going in cap rate. We bought it at a 5.8 cap rate. In year 5, we project 12.14% cap rate. So we bump up all that income, right, for 5 years, to where the NOI versus the purchase price that we bought it at is 12. And then when we go to sell it, what do? We drop it down to a very conservative 8.5 cap. Now, I don't have a crystal ball. I don't know what's going to happen tomorrow. But if you look at market trends, if you look at market cycles, if you look at the way the market is building and what's happening in the Atlanta market, maybe in 5 years we could sell it at a 7.5 cap.
What company you bought it?
5.8. 5.8, because the rents were low, right? That's a true value play, right? We paid a little bit more, but we understood that that journey of taking the rents and pushing them up, we can still make money even if we are conservative, right? So that's another chart. Here's more numbers. You want to feed people information. Let them decide what they're going to look at and what they're not going to look at. Here, we're deciding, right? On this one here, we're deciding what you're looking at, and you're not looking at a lot. There's not much meat, right? There's not a lot of meat on that bone for you to sink your teeth in. Here, we're giving you more. You see, we're telling you the sales price, what the broker cost is, at sale point, disposition fee, all the different fees, and what the equity gain is here, and then we break it out for you. Investors' accumulated cash flow, total return, annualized return, your equity, how much equity you're going to get, your total, boom, and there you go, you're 23,117. And then for the family offices, for the big guys, your internal rate of return. Here, again, if you're doing family and friend, I would not recommend you doing that. It'll just confuse the hell out of them, and you'll end up explaining something, and you'll probably explain it incorrectly, and you'll get everybody confused, and a confused mind says no. That's basically it, right? Why invest in Norwood Apartments, right? What's one of the goals of this property package? One of the goals, well, a couple of goals. One is you want to present an opportunity to people, right? But it's not enough to present an opportunity. People have questions, right? So what we want to do is we want to answer your questions before you have the questions. So that when you're done reading the package, you're like, I know everything I need to know about this asset, about the market, about the numbers, about the strategy. I have no questions, right? So why invest in Norwood Apartments? Why? Well, because time of the underwriting, blah, 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 the suburbs, the demographics, the investment partner who, again, this is for focusing for family office and whatnot, so you have the sponsor, the team, right? You have what's going on in the market, average effective rent increasing 4.5% from 2012 to 2016, 68,000 jobs, 120 international headquarters, blah, 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 blah. You can see, you can go on and on and on, right? Gwinnett County, one of the fastest growing counties in the nation for more than 2 decades. And we're buying assets in that market. So this is something that really tells people why invest in Norwood Apartments. One of the things that we have to do is we have to educate our investors on why we're going into certain markets. Why am I in Atlanta? Why am I in Utah? Why am I going to Cleveland? Why? Why? This is why. This answers the question. This educates the investor. Okay? And of course, we didn't see that anywhere on that one. The opportunity and the business plan, right? Great. So now somebody saw the numbers and say, wow, 23.5%, I like it. How are you going to do it, right? Again, answer the question before the question is asked, right? Leave them without any questions. So, what do we do? Okay? What are we doing? Okay? So it talks about purchase is consistent with the sponsor's multifamily investment strategy. Right there, it calms you down. So, what does it tell you? That the skipper of the ship, this is their bread and butter. They know what they're doing, right? You don't have to worry. It's not a multifamily guy now buying, what am I doing? Multifamily now buying, a solar farm, right? What does a multifamily guy know about solar farm? What does a multifamily guy know about buying a hotel? What does a guy who has a portfolio of hotels knows about multifamily? This tells you right off the bat that the guy who's running the show, could be whoever, this is their bread and butter. So it kind of eases everybody and lets the person reading this is a little more relaxed and knowing they know what they're doing, right? Then it goes into property units, the condition, what we want to do, and it basically talks, right? The property's units are in their original 1984 condition. The capital expenditure budget plans on updating units during a 24 to 36 month period, followed by year 4 to 5 stabilization. The renovations will be completed by experienced local contractors. So you really want to spoon feed them every little piece of information so that when they're done reading it, they have no more questions, right? Who, what, where, when, and how, right? And then the why, which we just answered before that, right? Why? Did we see any of that in this one? No. Am I losing you guys? Are we good?
Mm-hmm.
Are we good? Yeah, you gotta go?
Yeah.
You got it. We'll talk. Thanks for coming.
Yeah, definitely.
Can you get out?
Are you able to get out?
I think so.
Hey, it's upside down Steve. What's happening?
Oh.
Yeah, I can get out. Please.
Traffic had to be rough.
Check this out.
No.
Somebody else got it.
Strategic location.
That's your comment?
Yeah, blocking. Yeah, I was ready to be the first one to leave.
What?
I said I was ready to be the first one to leave.
Who do you need to?
I get, that's your car?
Yeah, the
Oh.
silver Honda.
Yeah. Come park in my spot.
Strategic growth, strategic location in a high growth area, northeast Atlanta. What do you see here?
Why not?
Going up. Success. Beautiful picture. You see the property, the main roads. You see how close it is to the main roads. And here's another pic. And you have all the areas. But watch this. Boom. Okay? Gwinnett County now. Multifamily submarket. Look at all the different pictures. Look at the just the presentation of it and the colors, the bright, vivid colors and pictures. Okay, property name right here. Comparables. Let's hold on. Where are the comparables here? No. Here we go. Comparables. Do you see the difference? Do you see more information is given here than here in the layout and the setup? Okay? Norwood Apartments property description. Now we're going into the not so interesting, very bland kind of information, because at that point we've already given all the sizzle, we've given a lot of the good information, right? We've gotten people hooked. Now when you send this out through DocSend, again, you can see what people landed on and what they looked and how long they sat on your property package. Okay, so this talks about the property. Again, you see the arrows pointing? We're going in that one direction. And this is basic information on the property. The address, the number of units, building, all that stuff. Okay?
Is DocSend free?
DocSend is free for a certain amount, and then it's I think like $14 a month.
$10.
Yeah, $10, something like that. And then on top of that, so we combine DocSend, right? And then once we send out our PPM and all that stuff, we do that with DocuSign. Okay? So you know, back in the day, 6 months ago, right? PPM, you email it to somebody, they gotta print it out, they gotta fill it out, they gotta scan it back to you before they mail it so that I can review and make sure everything was filled out correctly. Then I gotta email you back and say, it was great, please now put that in the mail and mail it to me. Wow, and we still raise money that way, okay? Right? But it's a long and arduous, and then you've got these accordion files with everybody's PPM and staff, and now you gotta keep it. And now I send out a link, boom, 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 right? Easy. Click here, click there, click, 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 boom, send. We get an email, you get a copy. 5 minutes, you're done. There's no paper, there's no headache, there's no signing. If there's an issue, we can fix it. We can send you an updated version of this, whatever it is. DocSend. When you're in DocSend, don't let anybody download the property package. They can only view it. Okay? Why? Because as you're going through, right, we talk lenders. Let's talk about lenders, right? You go to a lender, the lender says, I will give you, on a $4 million property, I will give you $3 million. Okay, great. You do your underwriting based on that $3 million loan with the interest rate and all that. Come 3 weeks or 4 weeks or whatever during the process, the lender says, well, you know what, or interest rate suddenly bumped up. Went from 5 to 5.25. Now you've got your different underwriting, different numbers. Oh my God, what do we do? If they downloaded the property package, you cannot change the numbers for them. You cannot adjust the numbers. If they just view it, you can go upload the new numbers with the new property package, and whoever has that link automatically gets the new version of it. Automatically. You don't have to do anything. Okay, so remember, when you're using it, make sure it's view only. Okay? Unit mix. Let's show here. Unit mix. Which one's nicer? Which one's nicer? This one? It's okay, you can say, you're not gonna hurt anybody's feelings. But look, the unit mix, right? It breaks it down in a nicer format, gives more information, square footage, occupancy on each one of that. How important is that to know? Right? Because if you're buying a property, and let's say you've got 30% one bedrooms, 30% two bedrooms, 30% studios, and the 2 bedrooms are, 80% vacant, right? But your 1-1s and your studios are 100% occupied, right? That tells you something about the market that you're renting to. Does it also tell you that when you buy it, you may have difficulties renting the 2 2s? That's going to be an issue for you. So maybe I need to look in that market and see, is this a market where there's more single people involved in it, rather than, couples? And so it's good information to help you. And again, you feed investors enough information for them to be full, for them to say, wow, really, these guys know what they're doing. They know. That's what you want your investors to say. Okay? There we go. All right. Planned renovations, again, you want to show nice, beautiful interior pictures of, obviously this is the model units, right? This is what you can see. What are we going to do to the property? You break it down over here, value add. I'm going to run through this because it's getting a little late. Julie will send you this as well, so if you guys want a copy, you can. Just when you're making millions, just remember us. That's all. Just give us a hey. All right? Again, what do you see here?
Going up.
Bottom left to the right. It's going up, right? It's always in that mind. We're always subconsciously putting it in there. have you ever looked at the FedEx logo?
Yes.
Take a look at it. What is inside the FedEx logo? It's a big ass arrow going from left to right. In that letters, FEDEX, right? Look at Amazon. Amazon has that smile. What two letters does that smile go from and to? It goes from A to Z. Because Amazon takes care of everything. And it's a smile. Okay? So much behind these things that we don't think of, but it's in there, right? When you break it down, you're like, oh shit, yeah. Oh, they've been getting me all these freaking years. Oh my God. Oh my God. I'm not buying from them anymore, right? Screw them. But you want to have that built in. Another picture of the property, right? Projected returns to investors. Now we can go into the more, talking about it and showing and how we're going to do the explanation part of it. But in the beginning, you want to grab them, you want to make them, just sink their teeth into it. Projected annual distributions to Class A members. They want to see how their money is broken down and where their money is coming from. So look, year one, this is the cash flow before taxes. 70% goes to the investors. The 8% preferred. This is what 8% looks like if you're going to go throughout the entire hold period. Okay? But as you increase the NOI, the split becomes more as well. So the first year is 7, 9.6, 11, 12, boom, 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 because the NOI goes up as well. You see how it goes up every year? So 70% of this is more than that, as you can see. So that is a 9.6% return. So that goes up. So they like to see that. Investors love to see this flow. Okay? They like to see how their money is being made. Then exit strategy, right? What's it going to be at the end? Now, again, we're talking to bigger funds, family offices, so we have a disposition fee inside. Who gets that disposition fee?
Us.
We do, just for selling the property. Pick up the phone. Hey, broker, sell my property. Okay, thanks. Boom. Give me 1%. Yes. But really, shouldn't we as syndicators get paid for knowing the market, knowing when to exit the market, knowing which broker to go to, and knowing which buyer to pick? How many times, you go out there, somebody puts a property under contract, 60, 90 days go by, haven't closed. Because that buyer wasn't a real buyer. So it's up to us to underwrite, to do a background check on that buyer, make sure that they have the money, that they have the resources, everything. Shouldn't we get paid for that? Absolutely. Now, when you're doing friends and family, and you've got savvy investors, they may come at you and be like, Cliff, you charging me 1%? You're not doing that. I'm not investing. I'll invest only if you take that out. And then you start negotiating here and there, and people do negotiate that, even family offices and other people. But you've got to stick your ground and say, this is what I'm worth. I'm not working for free. Okay? And then you got your sale price, broker, cost of selling, disposition fee, payoff, blah, 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 your net equity gain. Again, investor returns. How many times have we seen investor returns already? At least 5 or 6 times, right? It's in there, okay? And again, you got the IRR chart. Purchase and acquisition costs, mortgage information, all these numbers, okay? This is just, we inundate people with tons and tons of information. All right, here, look. Look at that. This is historical financials and pro forma. Look at that.
Year 1.
Year 1. Is there a year 2? Are we ever going to make it to year 2? Will we ever make it to year 3?
We shall into you.
All right. I mean, what, 12 months and we're done? Really? It's going to take only 4 months to sell the property. Here, you've got your T12, you've got your year 1, per unit of year 1, and you've got all the line items, the potential, vacancy, bad debt, net rental income, your other income, broken down utilities, reimbursements, laundry, cable, others, all the way through. 1, 2, 3, 4, 5, 6, 7. Now you see how we say year 1 and not the first year? It's a big difference. Because the first year is from the day you close, that's the first year. No. It's from the first year that we've stabilized the property, that we've made it, that we've raised the rents to where we think we're going to go. This is year 1. So that's your year 1, and you break it down. A lot of numbers there. Okay, I'll let you guys take a look at that. More numbers. NOI and cash flow. We're breaking it down for you even again, just in case you missed it the first 17 times, right? Again, net operating income and cash flow. We're breaking it down for you again. Investors' return and scenarios. You see that little dollar sign on the left over there?
I did.
Right?
That looks good.
Just
And it's gold.
and it's gold, and it's purple, and it's gold, and it's just all there. The one thing I'll tell you, what do you think is the one thing I didn't like about this slide?
Great.
Ah, you caught it.
It went from left to
It went down this way. I said, Laura, you gotta change this, blah, blah, blah. Oh, but then I gotta change. All right, leave it.
Fine.
We'll let it go. You got the dollar sign. That's fine. Okay? And this. This is the shit right here. Okay, this is the shit. This right here blows everybody out of the water. I call it the what if chart. It's the sensitivity analysis. Okay? What happens in green here? This is what we project at right here, right? This is all the numbers, returns, NOI, everything was based on here. Selling it, holding it at year 5, selling it at an 8.5 cap rate, and this is what you're going to make. What happens? I don't know, something happens, right? Economy goes sideways. We gotta hold it now. We gotta hold that property for another 2 years after we project it, right? So we gotta hold it for 7 years. And you know what? The market really went south. We gotta sell it at 9.25 cap rate. We got to sell in year 7. That actually might be good because we're probably going to make more money if we do that than sell it in year 5. Look at that, right? Because you're holding it more. It's going up. What if we needed to sell in year 5 at a higher cap rate and we just totally misjudged the market? Are we still making money?
Mm-hmm.
Are we?
Mm-hmm.
You guys over there, you're just looking at me.
Mm-hmm.
Yes, we're still making money. You're making 19% per year. Where else are you going to get that? Where you're not doing anything. Where it's not based on any other worldly market. Where it's not based on anything else but the asset itself and the market that it's in. If you had to, if we held it for 7 years and sold it at a 7 cap, or if we held it for 5 years and sold it at a 7.5 cap rate, look how much more we would make. What this does to investors is it gives them a range. It gives them a vision, because this is not a throw the dart and it's an exact science. We're going to sell it at year 5, at month 5, day 6, at 3 p.m. for this. No, we have no idea, right? We can just project in year 5 somewhere down the road. But what if we held it? And what if somebody came in year 4 and said, hey, here's an offer I'm going to make, take it or leave it. It's a great offer. You know what? So we made 23, we sold it here. Okay, so this gives you a best and worst case scenario so that the investor says, you know what? If we have to hold it, if it goes like this, we can still make money. And also for us, the syndicators, right? We do the sensitivity analysis and we see, well, you know what? If we do hold it for longer than we need to, then we're still okay. We can still make some good change for our investors. If we held it here and sold it, then let's do it. Then let's take this property. Because where are we now on the market cycles, right? We talked last time about market cycles in the different areas, right? So in Atlanta, in a lot of the major markets, we're about to crest in some places, right? We're still going up. But so what happens if it goes up and it starts going down and we have to hold it now? Right? That's a possibility. Well, we can still cash flow the property. It'll still make money. So the investors understand, and they also know that we understand that it's not an exact science, that it flows. It's something that flows in and out constantly, right? And it gives them a lot more comfort knowing that we understand that, and that we understand these numbers, and we can still make money. So this is something that I highly recommend you put in every one of your investment summaries, okay? And really highlight it. People love it. People really, really enjoy it. And this is how we got to the assumptions, right? Cap rate at resale, 7.5, 8.5, and we break it down all the way. 8.5 cap, 8.7 cap, 9.25. We are giving so much information to these investors that when they're done reading this, they don't really have any questions left, right? They're like, well, why didn't you do this before? Well, how can I get involved? I have a brother, I have an uncle. This is what we're hearing because of these packages. Is that good with the guy? Is that good with the guy? I love his eyebrows. I love his eyebrows. And then you have the team, right? And you have the team. The family offices and these guys, they want to know who the sponsor is. They don't give a shit about anybody else. Who's the guy or the woman running the show? Who's the skipper of the boat? That's what they want to know. What's their experience? And if you ever want to create a fund, a real estate fund, just so you know, your fund manager will be the most important person of your fund. Because if you want these people to invest $5, $15, $10 million into your fund, you need to have that fund manager with a strong background. We call it good pedigree, right? Good education, good track record, work with big companies, Fortune 500, Inc. 500, all you want to have a pedigree or else they won't even look at you. They won't even look at you. So you want to give them the information on that. And then our portfolio, what our vision is, okay? And again, I told her I didn't like this. It should have been slanted the other way.
Mm-hmm.
It
Yeah,
just bugs
I
me. But we
agree.
have this. We have this here, so it's all right. This is a picture of one of our other properties. It had a nice pool. And talks about the different assets that we have, properties that we closed on and so forth. And if anybody ever wants to ask us about this, then we're more than happy to get on the phone with them and share with them what we're doing. Property management company. This was the property management company that we closed with, that we started working with, RAM. They no longer are with us. They were very expensive, okay? But they were great because they understood that we were growing our portfolio, and they had one property manager that they bounced around to both of our properties, so there was economies of scale. But you want to put that in there because your investors are going to ask you, well, who's managing the property? Who are they? What do they know? Where do they come from? How many do they have? Blah, 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 blah. Answer the question before the question is asked, okay? Put that in there. Their history, what they do, all that stuff, okay? Just keep it in there. And then, if we didn't answer all your questions by this time, we have a frequently asked questions sheet, right? What are some advantages of investing in apartments versus single-family rental homes? When do you need my money? Right? When do you need my money? That's a great question, right? I need your money now. Click on the dots and send it in. Now, how many other investors are in the deal with me? Will I be involved in the day-to-day management of the property? This is the biggest one. This is the biggest one. How will I get my money back? Right? Because one of the main questions I get asked is not about the returns, not about the property, not about anything. Will I get my money back? That's the first thing, right? Will I get my money back, right? And going through the conservative numbers that we've shown them and the different charts and everything, it starts that, yeah, I will get my money back. And if they're as good as they say they are, it'll come with friends, right? Come with a lot of friends. How will I get my money back? And what am I buying when I invest in your deals, right? If you're starting to talk to your network and whatnot, and they don't quite understand, well, am I going to be an owner of the property? No. You're not actually an owner of the property. You're an owner of the LLC that owns the property. So it's a different setup, structure. Okay? Huh? Okay. Why do you have to follow the Securities and Exchange Commission rules? What could go wrong? It's an investment. 1,000,001 things can go wrong. Shit, you can have somebody drive their car through one of your units. Happened to us not too long ago, right? Happened in 2 properties. One guy just destroyed a 70-year-old garage system that, because the property is a historical building, now we got to build it back exactly the way it was.
Oh boy.
Are you kidding me? Why? Can we tear it down? Because nobody's using it. No, can't tear it down. Got to build it back up to the way it was.
It happened to me in two of my properties, so pretty more common than you would think.
Exactly, it's more common, you know? We had, in one of our properties, it was in Houston, Texas. We got a call from our property manager. He goes, listen, I got, you know, and it's funny because Dave says it also, but it's true. It happened exactly the same way. Guy calls us up, he says, listen, I got some good news, I got some bad news. Okay. Good news is that we had a shooting. No, he goes, bad news. We had a shooting on the property. Oh, okay. What's the good news? It was domestic violence.
Oh.
Okay, how's that good news?
Because it's all contained in one unit.
Because it's, right, it's not the neighborhood, it's not gang related, it's not crime related. This is some schmuck pulled a gun out on his wife and shot her. So it's just that localized into that one unit, right? But it happens, it always happens. So what could go wrong? What could go wrong? One of the general partners, the sponsor of the team, could take all the money and embezzle it and buy other things and disappear. What could go wrong? Go in foreclosure. What could go wrong? Again, answer all the questions, the good, the bad, the ugly, before they're asked, so that there are no questions, so that everybody feels good and safe and secure about what they're doing. Can I be guaranteed that I will get my initial investment back? Never use that word. That word guaranteed. Strike it from your vocabulary. Never say it. We don't guarantee anything. No, that's not right. I'll guarantee you two things. Death and taxes. The only two things you'll guarantee happen in life. You'll pay taxes, and eventually you'll die because you pay taxes. Because you pay such taxes. What is my exposure if things go bad, right? People want to know, well, what if the LLC goes bankrupt? What if something happens? What if we get sued? How am I, the investor, protected? You answer that question. Can I sell my shares before the property sells? Right? Savvy investors want to know, listen, I'll give you 50, I'll give you 100, but if I need my money back, how can I get my money back because I want to do something else? Right? Answer the questions before the questions are asked. And then boom, you're done. Contact info, here, and you're out. So, did you guys see the difference between this, which I don't even know what we call this, they call it a property package, and this, an investment summary, something that excites you, something that says, wow, you know what, these people know what they're doing, they spent an incredible amount of time putting all these things together. Oh, and one thing, what's cool, okay, I did not put any of this together. I helped with the text, I helped with a little bit of the design, but the actual putting together was my partner Laura. All these charts, when she's creating it, all these are linked to our main Excel spreadsheet. So when we go into our main Excel spreadsheet and we change something there, all these numbers on all these different charts, they all change automatically. So we don't have to go into each one and, this was 550, okay, change 5 here. And okay, did I miss one, right? Because there's so many numbers, so many things. One page can say one thing, another page can say another. And that's when you really get messed up, because the investors are like, dude, you just gave me 3 different NOIs on 3 different pages. What are you talking about here? So it's all linked together, so when she goes into one cell, it just pops everywhere else. I have no idea how she does that. It's magic to me. It really is. But that's how she does it. So this is the winning presentation, okay? Take it home, go through every single page. Look at how that page makes you feel. What do you think about the information? Right? Was it too much? Was it too little? Did it hit a nerve? Where did it hit a nerve, right? What excited you about it? Go home and study it, and then put your hat on as an investor looking at it, right? Saying, I want to invest in this property. Is there enough information? Is there good information? What information is missing? And then start tweaking your projects and your numbers. Did I help you guys a little bit with putting that all together? Yes? Okay, great, awesome. So I know it's 9:17, you guys came a long way. I appreciate it. Next meetup will be in January. Next year. Oh shit. Oh my God. I just celebrated New Year's last week. Oh my God, it's incredible. It's absolutely. So do me a favor, quickly, before you go, did you get one of these? No. Do me a favor, fill these out for me. I would really love your feedback and everything on it, on the different things. And again, this just helps. You need a pen? Oh, you got it. I want to thank Abraham and Julie. As I said, this is not only their workspace, but this is their home, and they opened it up to us, and I want to thank you guys so much. Thank you very much. And Abraham and I own a commercial real estate brokerage company. If you guys are looking for assets, if you're looking for multifamily, if you're looking for hotels, different types of assets, hit him up, okay? He's been doing this since, I told you, since they were knocking stones together. But he is a wealth of knowledge, a wealth of experience, and he's got contacts all over the world. All over the world. I'll share with you one small story, and then we'll go. Abe calls me up, he goes, hey, listen, I'm meeting with this guy from Qatar. They've got money, blah, 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 let's get together, and we'll meet him in Miami. They want to buy hotels, and blah, blah, blah. Okay, so we're sitting there, we're talking, right? The guy's name is Mansour. We're talking, we met the guy, Abe takes Mansour after that, and they go, and I'm sitting at the hotel at the bar, and I open my laptop, and I'm working, and Laura calls me, my partner. What are you doing, blah, 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 where are you? I said, well, I just met with Abe and this guy from Qatar. What's his name? What's his name? Really? You know somebody from Qatar? What's his name? Mansour. Oh, what's Mansour? What's his last name? I think it was Al-Khattab or something like that.
Navina.
Huh? Navina, right. She's like, oh my God, give me Abe, I'm calling Abe now. Okay, she hangs up the phone, she calls Abe. Abe, put me on the phone with Mansour. Okay, Mansour, hello? She starts talking to him, this and that, and when she was 14 years old, her grandmother was 16, 15, her grandmother sent her to London to go learn English. So she was staying in like a youth hostel, a guest house, and next door to her was this guy from Qatar, and they hung out, and they played cards, and they, got to know each other, and this and that, and this is going back 30 some odd years already, right? And she goes, Mansour, I was the French girl next door to you. That was the Mansour that was hanging out with her when she was 14 in London.
Wow, small world.
Small world, man, small world. This guy knows everybody. He knows, absolutely. Wealth of information, can help with underwriting, can help with analysis, can help with finding a good market, a good property, all that stuff. So really, hit him up. And for design, interior, if you guys need help with colors and what's going on, you've got Julie here who's awesome at it, as you can tell, She's like, hey, leave, let me deal with it. He left, we went to hang out, we had a couple of drinks, we came back, it was all done. All the little else she's got running around here. But we'll send out an email letting you guys know what is good for you guys. More towards the end of January, would that be a better date for the next group, for the next meetup? You guys are just looking at me like I'm you have something on my forehead?
Like the week of the 6th.
Do I have like a little bindi dot over here somewhere? My eyebrows okay? You're just looking at me like, huh?
Second week.
Second week? Okay, second week.
better.
Also, what I've done, I created, since we're ending the year, okay, and we're starting a new year, I know a lot of times for myself, when I was getting started and I was moving, I didn't really have anybody to help me strategize, build my goals, set my vision, and put the pieces of my business in place, in the right place. So I was thinking about it. I said, how can I help people? And I created this little system, little program. We start now. We do a review of 2018. Okay, what worked, what didn't work, what we would like to adjust. And then from 2019, we create 12-week goals, not yearly goals. Okay, we're going to condense it into 12 weeks. Okay, I'm really big on this book. It's fantastic. I love it, and it's doing wonders. We're going to set 12-week goals. We're going to create a vision statement, a mission statement, and it's very important to have a vision statement. Because when you have a vision statement, you know where you're going. You know when you have a question about the business, about how to take the business, you look at your vision statement, and that should answer your business question. And then we'll create the mission statement. The mission statement tells us how we're going to get our vision, how we're going to build our vision. We're going to have an introductory call, about an hour and a half call. I think like 1 hour, one call a week, right? 1 call a week. Emails, unlimited emails, up until the first quarter of 2019, okay? And I'm gonna help you build all that. How many brokers, create systems, create everything. So that, you know, I was looking at pricing, you know, it's hard to just go out and, you know, I need to pay, I have kids, I gotta feed them, you know, and they eat, man, they eat. They're eating me out of house and home. And my daughter eats, she finishes, she goes, I'm hungry. Dude, you just ate, you still got crumbs on your face. I'm hungry, I want more. So for this, it's $14.99, okay? It's $1,500 for the review of the entire year, build out the next year, and you've got me for the first quarter. So if there's any interest in that, put it down on the piece of paper that you're interested. We'll sit down, we'll talk, and we'll start working on it. Our first call is about an hour-and-a-half introductory call. This is where we talk about last year, what went on, what happened, what tools we have, where we want to go, and then we're going to start creating the systems and putting everything in place and going forward with that, all right? So I put that together just to help people out, because I know there's a lot of moving parts. There's a lot of things, right? We can go out there and we can be investors, or we can create a company that invests in real estate. It's two different things, right? What do we want to do? We want to have a company that goes out and buys real estate, and we can build that company huge, or do I want to be that one lone investor, right? So fill those out. We'll get them back, and we'll start building on that. And for that, thanks again for coming. I appreciate it. Did you guys? Was it good for you? Was it content? Was it well presented? You guys enjoy it? Okay, fantastic.
Yes.
Thanks for coming, guys. I really appreciate it. Thank you very much.